faces. Everybody looking energetic, very exciting. Excited to be, uh, I think they call me program or forum coordinator, something like that. But with your help, with your assistance, I believe we'll make this into a very productive event today. We together here as stakeholders make up the capital markets of Eswatini. It's a deep and liquid capital markets that is fundamental to economic growth because it helps channel the long-term domestic savings of our economy to the most productive uses that we can. And it's an important step then towards developing a well-functioning capital markets that will develop our economy by making sure that we develop the buy side, which is the retirement funds, the insurers, the collective investment schemes that are represented here today. And if these institutions can be more efficient at allocating their funds into the longer dated alternative investments to match their long-term liabilities, then as a byproduct, the nation's economy will be stimulated. They will achieve better returns for themselves through the reduction of risk by way of diversification, which, by the way, is an undisputed benefit of investing in alternatives. Jobs will be created, communities will be developed, and funny thing is today's venue here, this hotel is actually a very good example of such. This was the brainchild of a retirement fund that decided to match its long-term liability to an asset, and this establishment over here will be well into long after you and I have actually passed on. It will continue to thrive, break even, and benefit future generations to the benefit of future generations. And what that means is that somebody sat down and decided that in order to match our long-term liabilities with our long-term assets, this is actually the way to go, is to go into alternative investments. And so that's exactly what we hear about today, to basically find ways and encourage dialogue that will speak to how we participate as collectors of funds from our members, from our policyholders, and so on, and direct them towards long-term investments. I would have been happy to see the regulator here. I thought they would be coming because I'm very much interested in knowing what the regulatory framework they put in place to allow and foster our investments into alternative investments, because that is the way of the future. We need them as a regulator. We need everybody, really, everybody in this room, but as well as the policy makers, as well as the regulators and their regulations. They need to actually assist us in fostering an environment that will allow for allocation into these long-term investments. So really, I look forward to more of a dialogue, and that will get participation from everybody here. And there are actually a myriad of opportunities that we can get into in this space. So I think the times of looking at traditional investments as the only investment that our institutions can go into is one that is long gone. The opportunities now actually are in the alternative investment space. We've got infrastructure to continue to develop. We've got green bonds to fight climate mitigation. We've got energy security, which is actually topical for us as a nation. And all these things like the opportunities that are going to come out of the Topical Sectional Titles Act, all those are investments that we need to get into, take advantage of, and help drive our economy, stimulate our economy. Now, I hope and believe that such intermediaries as fund administrators and investment consultants are also present here. I hope they are well represented here, because their role is actually of extreme high importance as well. It would be false to assume that it's just the regulators' thresholds and limits that are keeping institutions such as ours from investing in alternatives. The truth is, you find that in a lot of cases, the boards of trustees, basically the people that make decisions on where to allocate funds, they are the ones that they feel a bit skeptical in getting into alternative investments for various reasons, and some of them being the fact that they feel they don't have the capacity or the familiarity with regards to evaluating the associated risks with this sector. So we therefore look to administrators and investment consultants to provide the much needed guidance in this particular case. Now, I hope that we'll also have in-depth conversations about the need to have sound because, what is the incentive really for a board of trustees that feels like they don't understand the risk in alternative investments? What is the incentive for them to So we need to strike that balance. We need policies that will allow that. And unfortunately, if less institutional investors are willing to participate in alternatives, then there'll be less new issuers in the space. And then you find yourselves with this whole chicken and egg dilemma where, if we don't have the funds coming into the sector, then we won't have issuers coming up with investments that are by our various esteemed speakers. And so I wish that we all have an enjoyable and productive Eswatini Institutional Investor Forum 2023 over the course of the 1.5 days that we'll be here together. I thank you. So as our first speaker, though, I would like to welcome Mr. Wayne Hiller. He will come to the fore. I don't feel the need to go into his biography. We all have these booklets in front of us, so we'll all have a chance to read through it. But Mr. Wayne, thank you.
Thank you. Good morning, everyone. I am not going to share a presentation. What I have done is I've prepared a talk. I'm going to record it, and then based on the feedback and things we've done this morning, I'll update it and I'll share it with everyone as an article afterwards. Put so much time into presentations, and then you don't really do anything with them. So this is my new modus operandi. That aside, just to share that with you, I'm going to just press record here on my devices. You'll see my history there, but I mean a particular interest of mine, besides all the other things that we all have interest in, is governance, and then besides governance, and closely linked to it, is investing and how we can use capital that we have to make a better world. I know it sounds a bit kumbaya and everyone's doing it, but let's think about this closely and seriously. When we have an investment manager standing in front of us, they're doing two things. They're presenting an opportunity for us to take the capital we have and do something positive with it. Generally, that means generating returns for the members that we represent. Secondly, they would then hopefully give us the purpose. And I'm going to get into the formal stuff now. But I think historically a lot of our investment thinking has been around risk and return. And that is like every presentation we probably had, for those of us who are older and have been doing this for a long time, probably heard this for 20 years, more. But, what is the third element? And I think today is the third element, and a lot of thinking around this is there in the world today. Is like, it's not just about risk, it's not just about return, it's about impact as well. So I think that's been the big shift that we've seen with investing. And although I'm not talking to alternative investments particularly, that is really one type of investment vehicle where you can look at the risk, look at the return, and in many cases see the impact more directly than you would, investing in a big listed company somewhere. The impact's there, but some of it's just so distant from the investor or the people doing this that you don't really see it. So, all that being said, what is it and why do people perceive Africa in particular as a difficult place to invest in? If we look at those three matrices, or whatever the right plural is for a matrix or measure, is that we nearly get stuck around the risk conversation. In the particular countries we live in. And when I look at the sort of very broad definition of what it is, and we'll talk risk and then we'll talk about some of the things that the opportunities that are presented. Investing in Africa, and we're talking Africa here as a country. If you're not an African, people perceive us as a country. Investing in Africa has long been considered a high-risk type of investment, and the main reason for that is, again, and I want to not limit it, but really concentrate on three areas. Is historically the risk perceptions have been around political instability. We all know that. The other element has been around weak governance. I don't know if that's necessarily true just for Africa, but those are the other elements that are often cited, or another element that's often cited. And then thirdly, the lack of financial infrastructure, or the limited financial infrastructure. So when we look at developed financial infrastructure, there are few economies in Africa that have a sophisticated financial infrastructure, which often is attractive to investors who want a quick in-out. But those are really the three big elements that have prevented probably the international. Sorry. Now, sorry, Siri. Be quiet. Yeah. So when we look at this, and I think we all know this, is we've been called, if you're speaking from an international perspective, to reevaluate risk. But I think as local investors, we need to also reevaluate risk and understand what it is that we really need to consider. If we start with the positive slant around what it means to invest in Africa, and as an aside, for those of you who are really interested in risk, there's an ISO standard on risk these days, which focuses on the risks, but the one element it really focuses on when you're evaluating risk is there's no risk without an opportunity, or there's no risk without evaluating what the other element of that is. So when we're looking at risk and risk perceptions, we always need to look at the opportunity as well. And when we think about opportunity on the African continent in particular, World Bank statistics may be a little bit outdated, but not particularly far off, 6 of the world's fastest growing economies are African. The biggest, what do you call it, the demographic dividend is African. 60% of Africans are younger than 25. Then the third element that is also being highlighted is the very conscious effort of African governments to create enabling environments to facilitate investment. So although Eswatini isn't one of the ones that are particularly mentioned when you look at the research, the one thing that we are aware of is that the opportunities exist with these risks. And let's focus a bit on the opportunities, and then we can maybe get back to the risks at a later point. So we've spoken about fast-growing economies, and those aren't only fast-growing economies related to resource-rich countries, i.e. Nigeria, South Africa, DRC, all those places. They're talking about smaller economies as well, and that is that very concerted efforts of government to create those enabling environments. Then, secondly, we've got the demographic dividend. This huge group of people that are going to come into force soon, and linked with a demographic dividend and with the economic growth is the growth of the African middle class. And I'm not going to go into statistics, I'm doing big themes here, but I mean the growth of the African middle class is one of the big investment opportunities that exist. And a prime example again would be something like this hotel, healthcare, hospitals, schooling, and I'm using some very basic examples, but those are the areas and opportunities that have definitely been identified. And then the element I think that, or the theme that I think would probably be the most exciting for African and African investors would be technology and the adoption of technology. When we think about the adoption of technology across the continent, and in particular things like M-Pesa in Kenya, where, I don't know how much electronic, the sort of virtual money is going around, but that is a significant development for transfers, reducing the cost of transacting, the ease of transaction. So that would be the additional element, and I'd say the fourth element that you'd look at as an opportunity. And what I wanted to talk about when you look particularly at alternative investments and the pools, and when we want to kickstart this growth, what we as institutional investors in Africa have is a deep and thorough understanding of our local economy. So it would be South Africa or Eswatini or wherever it is. And we often need some form of guarantee. And how do we de-risk these things? How do we take some of these things that are perceived as risky and make them less risky? And we go back to that concept of risk, return, impact. Is there has been a steady development when it comes to alternative investing, and in South Africa in particular, and some of it has happened in Ghana as well, around co-investing opportunities as one way of de-risking whatever you perceive to be the risk that there is. And essentially what you're looking at is partnerships between institutional investors in South Africa, or Eswatini, possibly depending on the law, and again you just need to look at the regulatory environment and then create an enabling one, inviting international institutional investors, especially those with big checkbooks. So the one development that we've seen in South Africa has been very US focused, where there have been US pension funds that have come and co-invested or created a forum not much of the capital has flowed from there as yet. But when we look at a whole world, we have established European pension funds with deep pockets. We have sovereign wealth funds from across the world, so that for those of you who don't know what a sovereign wealth fund is, I don't think I particularly know the details, but that's when a rich country like Dubai or Saudi Arabia have lots of extra income due to the oil dividend, and they create a fund that basically funds things for the country at some future date. So it would be pension funds, things like sovereign wealth funds, and sometimes you have development organizations that are called lazy capital or easy capital. They don't want to listen. So why I'm mentioning these things in this context is we've got risks, and often these risks are very particular, but there are ways of managing these risks. By inviting people to co-invest with us, we are creating the ability to generate a bigger pool and more opportunity to use that pool of capital to invest in various areas. So although this hasn't been expanded, it's something that I think is really worth considering, and something of and not that I'm promoting it in any way, and I'm not directly involved in it at the moment, is going forth and saying, we've got alternative investment opportunities. What kind of budget do we have? What kind of budget do we need? Can we carry all of this on our own? And do we want to carry this all on our own? And how do we mitigate any of these risks that we're talking about, if we're focusing on risks? So risks will generally be around failures of whoever to pay the money that they need to pay. There is, and again, if we get creative, and I know this is probably talking more to the investment managers or those people who make the investment decisions, of creating partnerships with foreign investors, fund some element or guarantee investment. So let's go back to the risks. And I mean, I'm not going to go into this. I'm talking very generic risks here, and we know that each country has very specific risks. I mean, we were talking about energy security. I mean, South Africa's got a big issue around energy security, as we know. One of the byproducts of that energy security issue is the growth of green energy production in South Africa. So what we've seen is wind farms, lots of institutional investors, and they need to have that access to healthcare, food,